much. I'm really excited to present this to the Bank of Israel. And I should say I'm beaming to you from Portugal, where I just spent 3 hours giving a class sort of to the Bank of Portugal. So I'm a little bit fried, but I've been eating a lot of sugar. So hopefully I'm up to the task again. So this is joint work with Ross Levine. And just to give some background on this, you know, in 2018, the Jackson Hole Conference was, it was about how changing market structures were going to affect monetary policy. So there were 4 different papers. Our paper focused on what the implications for changing market structure were for the banking industry. So that's where this comes, and this is joint work with Ross Levine. Okay, so and people can probably see my little the hand here. So this is just a plot of U.S. banking concentration across time. So, and the horizontal axis is year. We're using call report data from the Fed. And it really starts in 1984, the good data in 84, and we have this up until 2019. So what do I want you to take out of this? So if you see on the left-hand scale, vertical scale, is the number of banks, and you see just a drastic change over time in the number of banks in the U.S. So it's more than cut in half, basically. It went from over 11,000 to under 5,000 in 2019 or 18. At the same time, what you see is roughly up until 1990, let's say, you see a very flat market concentration of the top 4 banks. So that's what's listed on the right-hand scale. This is the top 4 bank assets share. That was roughly, I don't know, in the 16% range. Then it starts creeping up. There was something really important regulatory change in the United States in 1994. It was the Regal-Neal Act. And basically prior to 1994, at a national level, banks were not allowed to cross, it was a national law, across state bounds. Prior to that, however, some states did allow banks, so that's 1994 is where we are right here. Some banks were allowed, some states did allow cross state branching. And as you see, once that starts happening, banks are moving into other states, buying up other smaller banks, and the market share of big banks starts to rise. After Regal-Neal in 1994, it just grows tremendously up until the crisis. Then following the crisis, it's leveled off. In fact, it's kind of dropped some. So, while banking concentration is not a measure of imperfect competition per se, it's, oftentimes, and regulators use this when they're thinking about how competitive is a banking industry. The other thing I would kind of note to you, because it'll figure into both our empirical stuff and our model, in some sense, how we take the model to the data, is that, in some sense, there was like roughly a 20-year transition period between, in some sense, two steady states, let's say, okay? So, so our paper is really going to be about what are the implications of rising concentration on things like efficiency and stability in the banking industry. Oops. Okay, so remember the title is Competition, Stability, and Efficiency. So in the banking industry. So from Econ 101, we're kind of used to the fact that if you have too little competition, that can be bad for social welfare or efficiency. One way that markets measure this efficiency is how big the spread is between lending and deposit rates. So that would be the interest margin. If with perfect competition, it would be very small margins. With less competition, large margins. But the thing that we were kind of focusing on to some degree is what are the other implications of competition. So too much competition, on the other hand, could in fact be bad for social welfare. And this is not something, that we're the first people kind of saying this. There's been lots of different literature. It's a very simple idea that if I have more competition, it's going to erode bank profits. And if bank profits are low and that translates to charter values, the present discounted value of future profitability, if those are low, it's going to weaken incentives for making good loans. So it basically increases the potential for moral hazard problems. Banks may chase risky higher returns when they're making very few profits. In some sense, so that's what we're getting at, is that with too much competition, it may be desirable to take excessive risks. So now, you kind of have the three words in the title: competition, efficiency, and stability. And that's what this paper is about. So what we want to do in this paper is think about how regulatory and monetary policy affects market structure, and how market structure itself may affect risk-taking, bank efficiency, and lending, which are the goals of some of the goals of monetary policymakers. And so really the question is kind of what's the appropriate degree of competition for the economy? And here I'm going to shout out to Jonathan, because Jonathan has a paper that is very nice, also thinking about what's the appropriate degree of competition in the banking industry. So, the two papers are a little bit different, but we're kind of getting at some of the same questions in this framework. By the way, ours is a lot simpler than Jonathan's, so I applaud Jonathan for what he was doing. So what do we do in this paper? What we're going to do is provide this very tractable, dynamic model of the banking industry and use it to conduct policy experiments. And then, Ross is an amazing empirical, financial development guy. And so he has constructed a really cool data set that we're going to use to kind of test some of the predictions of the model. So what are the model, kind of implications? What we'll have is that, more competition can increase market efficiency. So that's the benefit of more competition, but it can, in fact, lead to more bank instability. And so what we're going to do is focus on a couple of different policies. Ross was, I think, on the European Stability Board at the ECB, and one of the things that they focus on a lot is was the role of bank governance. So our model is going to have a real role for bank governance. You'll see what I mean by that. We're going to also allow there to be leverage constraints, basically, in the model, and those kinds of policies can actually enhance stability, but they may have different effects on efficiency. So what we find is that eliminating agency conflicts actually gets both right. It leads to higher market efficiency and greater stability, while tightening leverage, it enhances stability, but it comes at the cost of potentially changing interest margins and markups in the economy. We actually find, and I'll show you how the model generates an interaction between the two. Both policies can be used to try and enhance efficiency and stability. And then finally, what we're going to do is I'm going to show you how monetary policy actually might affect risk-taking and lending in the economy, how the model can think about that. just the intuition for that is if banks have lower profitability when with contract policy, if then there's going to be less competition, less incentive to enter, and less competition. And what kind of motivates us as well is there's this, I think, really interesting paper by Kashyap and Stein, which is basically a corporate finance approach to thinking about bank lending, the bank lending channel. And what they found was that smaller banks are more sensitive to contractionary policy than bigger banks, and that's going to be something that we're going to have as a consequence in this model. I'll show you how that arises. Okay, so here's I'm about to finish just the intro. So this is going to be, I'm going to present you with a model. It's going to be a very simple version. So I have a paper with Pablo Durasmo, who's of the Philly Fed, that came out in 2021 in Econometrica. It's entitled Capital Buffers in a Quantitative Model of Banking Industry Dynamics. It's a very complicated paper, frankly, and that's partially the complication arises from trying to match the US data for the banking industry. In that paper, we have banks of different sizes, et cetera. So it's not a simple paper. And so the goal for me in this paper is to try to bring out a lot of the ideas from that paper, but in a really simplistic paper and framework. And this paper is going to amount to 3 equations and 3 unknowns. So I think we can all solve that kind of a simple problem. So what's at the basis of this paper is actually some work from Franklin Allen and Douglas Gale, who kind of wrote down a very simple model of banking imperfect competition implications for financial stability and stuff. So the first 2 points here, that bank managers compete for insured deposits and choose the riskiness of their loan portfolio, as well as the fact that the loan portfolio riskiness determines the probability of bank failure. They wrote down a simple static model with an exogenous market structure to kind of think about those 2 things in the first 2 bullet points. And we're going to borrow, from that. But what we're going to do is embed that in a dynamic framework. We're going to allow there to be shareholders who inject initial equity to cover entry costs. And that entry condition is going to endogenously determine the number of banks. So both the dynamics and free entry is not in that model. And we think it's very important for policymaking to think about the implications, the long run implications of policy for market structure. So, the picture I showed you at the very beginning, changing regulation had a humongous impact on concentration in the US banking industry. After this 20 years, you've got a doubling of concentration in the US banking industry. So policy should be kind of thinking about the impact of that in the long run. What we do in this paper is have both a short run and a long run. So I'll think of the short run as being one in which the number of banks is fixed. And then in the long run, the number of banks will determine how did policy affect the long run number of banks. Anytime that policy affects a bank charter value, that affects efficiency and stability in the short run. But because it also affects charter values, it affects long run obligations and the entry condition. And so, what I hope for policymakers to kind of get out of this framework is that there's really a fixed point here, that if the goal is to have something like financial stability, and if it's the case that market structure affects financial stability, policymakers should be kind of thinking a little bit about what the implications are of their policies for market structure. And then what I'm gonna end with, and hopefully I've got to try to keep enough time. Is an empirical part, which is based on the data that Ross Levine has, and he actually constructed this very novel data set that uses basically a gravity model borrowed from international trade models to generate both individual bank, state, and time contingent measures of competition. And so we're going to regress a measure of bank risk, which is going to be the volatility of equity returns, on different measures, including a measure of contestability or competition in the economy, and see what the implications are for stability. And I'll show you that the model generates the same predictions as the data that he has. I'm done with the introduction. If there are any questions, I think it might be good to hold off with questions until I show you the environment, and then we'll kind of talk about the environment a little bit. So what's the physical environment? So as I said, this is going to be something that's in some ways borrowed. This part is borrowed from Allen and Gale. So there's going to be a risky technology, and I'll just say that if you see certain colors, so what do these colors mean? So a color that's red means that this is going to be the choice of either a planner, a policymaker, or a bank manager. So and then the parameters in green are, we'll just think of those as parameters of a model that we're going to try and take to the data. So as in Allen and Gale, there's a risky technology. The scale of the technology is going to be associated with return. So higher S means higher return, but it's also going to have an implication for likelihood of success. So if I choose a scale of S, I'm going to get the technology is going to yield a return of A times S with some probability P of S. With probability 1 minus P, it yields 0. But the probability of success is going to depend upon the return in some sense. So if I want high returns, so S is high, the success rate goes down. So that's generating a risk-return trade-off in the model. This is just something that Allen and Gale do. It's a nice, simple way to generate a risk-return trade-off. Since we're going to take this model to very simply, in some sense, to the data, I'm going to parameterize this technology, and I'll think of this parameter eta as somehow thinking about how, given that we often think about fintech, I'll think about eta as being some measure of financial technology, and a higher eta makes for a better monitoring technology. In the environment, if I invest Z units, that the benefit is that the expected payoff is P, this is the expected value, this is the payoff per unit of that's put into the technology, and this is the number of units that are in input or invested in the technology. But that costs something, and so there'll be like a just nice convex cost to doing this investment, and it's again, there's a parameterization to the costs of investment. So this is exactly what's in Allen and Gale. So let me move on to how to think about that, taking that technology and putting it in a market environment. So as in Allen and Gale, actually, there's you can think of there being N banks, and these banks are going to Cournot compete for insured deposits. That part's the same, But what's going to be different is that free entry is going to pin down, the number of banks. You can think of there being an initial equity injection that's made, and that initial equity injection covers the fixed entry costs of the given bank. Then, just to keep things simple, we're going to say that that seasoned equity is prohibitively costly. So that just makes our balance sheet be really simple, that the number of deposits that are taken in are equal to the number of loans that are sent out by the bank. You know, the paper with Pablo, we have, sort of seasoned equity that's not prohibitively costly. It's kind of a little bit more along the lines of Joao Gomes's paper, AER paper, that was for non-financial firms, but we have costly equity issuance and stuff like that. So, in a more general model, I would do that. But here, it just keeps the balance sheet really, really simple. Banks, when they want to raise deposits, they face an interest rate that depends on all the people that they're competing with. So if they're if there's lots of people competing for external funding, it's increasing. They're going to a given bank is going to have to pay an increasing interest rate on their deposits to attract loans. Okay, and then. And so that's also, except for the initial equity injection part that's going to be important for free entry, this inverse deposit supply function is something, again, that's in like an Allen and Gale framework. In Allen and Gale, bank managers choose the riskiness of their loan portfolio, S, and their deposits. In their paper, it's a static model, so they just maximize static profits. Here, because we have a dynamic model, we're going to have we're going to maximize the expected discounted value of profits, and our bank manager is going to have a discount rate of beta, and so the bank manager is maximizing expected present discounted value of future profits, and that's subject to a leverage constraint. So the stuff in blue here, I'm going to think of those things as being policy variables, okay? Now, you might be asking, why is blue a policy variable? I'll get to that in a second, but here's a leverage constraint. So, if I want to, if banks, very highly levered banks are more likely to be risky, what a policymaker can do is just lower lambda. So make the leverage constraint, tighten the leverage constraint. There's limited liability. So funds have to be injected if a bank is insolvent. I'm going to think of there being additional costs of external funding, and I'll kind of think about that as the costs associated with borrowing in the Fed funds market. So if I want external funding, it comes at a higher cost. The higher is alpha. So alpha is like a policy parameter, like a Fed funds rate. And then the shareholders themselves are going to have linear preferences, and their discount factor is going to be, so they're less myopic. Shareholders are going to be less myopic than bank managers who are more myopic. And that's the way we're going to generate this agency conflict that the ECB Stability Board was kind of so worried about. Okay, so that's the environment, and if there are no questions on the environment, as I said, really it's just kind of taking Allen and Gale, and embedding it in a dynamic framework that has free entry, and the idea is to kind of say what are going to be the implications of things like these policy parameters on riskiness, bank choice of how risky their loan portfolio will be, how much bank lending will go on, and what will happen to bank market structure. So that's kind of the idea behind the paper. Okay, I think this is, if I get through in the next slide, this will give you a lot of intuition for how the model will work. Actually, I have 2 slides, and then the model hopefully will just become very, very clear. So what I have here in equation 1 is just the static profits of a bank. So the bank is, taking as given the current market structure. So that's the number of banks it's competing with. What the profits are with probability P, the project is successful. The interest margin, or the markup over the costs of getting deposits, is what I will call the interest margin. So the benefit, sort of return on the loan, you can think of as being A times S, and the cost of that, of getting the deposits to make that loan, is RD plus any external financing costs, alpha. So it's just basically, and then with probability 1 minus P, the project doesn't pay off, and that's why that's gone from here. But so this is just basically, it's the static profit is the expected return, the expected interest margin that the bank will have. We embed this in a dynamic framework. So what's the dynamic optimization problem? Well, again, starting today in a given market structure, the bank manager is choosing an amount of riskiness of its loan portfolio, how many deposits to take, which it lends out, so the amount of loans to make, to maximize current profits, but also the expected present discounted value of future profits. So, this is where there's lots of theories of banking that depend upon charter values, and that's going to figure in to how banks make decisions. So, a bank may choose to, have lower riskiness in order to keep getting higher future profits. So leaving this out really might affect doing a static model really does change in some sense, potentially, quantitatively, sort of these kind of measures of bank risk taking and lending. So this is, yes.
We have a question from Michael Goffman.
Hi, Michael.
Hey, Dean, how are you? Good to see you.
Good.
The alpha in the equation one, why is it multiplying DI? Because it looks like that the cost is RDZ times DI. That's the cost of deposits, right? What you pay to them. And then if you borrow more than what deposit you have, let's say that you borrow in the interbank market, you will multiply that amount by alpha. But here you sum up alpha and RD and Z and multiply by D. So I didn't understand this part.
Yeah. So good question. I mean, this is just a reduced form way to get that in. Okay. So it's just, I totally agree with you that you could, if you were to put in a Fed funds market, you'd have another, the bank balance sheet would be, now it'd be expanded, right? And we were just kind of trying to get at in the simplest possible way how policy, this alpha may affect, your costs of getting funds. This is a reduced form way. What you were suggesting would be is a deeper way, but we just.
What is the interpretation of alpha if I just use deposits? So I pay to deposits RDZ, and then there is a markup from the Fed. What is the interpretation of this markup?
So is
it like FDIC insurance kind of thing?
In Allen and Gale, so we're going to think of alpha as having 2 components. One is exactly the FDIC insurance, so that's like 2 to 3% in the U.S. And then we're just doing this very reduced form way of saying, well, if the Fed starts raising Fed funds rates, it's going to make my external finance more costly. But I agree. I mean, a a deeper model would have that be deeper.
And the last question, the alpha affects the N. The alpha affects the N endogenously, like when you do the entry condition, if you have higher alpha, then you have smaller N.
Yeah, it's gonna,
okay.
Yeah. So I'll show you how that works. Yep.
Okay, thank you.
Thank you very much, Michael, for your question. We have another question from Eliezer Bronstein.
Hi. So a very quick question. You refer to beta and delta as reflecting myopia. And in my mind, myopia means something is irrational. So is this the sense here, or is it just different time preferences that could reflect, as the word says, preferences?
Yeah. So this is, I mean, again, this is kind of a reduced form way to get at. I mean, I'm gonna take it that the policy may actually be able to change beta. Okay, so it's not like I'm going to think of this as irrationality. I'm going to think of this as bank managers are more myopic than shareholders. And so what governance, corporate governance, so they want to really focus on maximizing short run profits. Now, what could corporate governance be? Well, it could be taking a compensation package for a bank manager and backloading that compensation package to make the bank managers, short run myopia kind of get closer to taking the decisions of long run shareholders. So it's again, this is just a simple way to kind of get at stuff. When we go to the data and look at the, like run some regressions, the way we're going to kind of model better corporate governance is just like, what the institutional percentage of on a board, more institutional investors on a board may have better corporate governance, et cetera. So I'll show you how that works in the data in some sense, but that's, yeah, it's not, we're not thinking of it as irrationality necessarily, but I am kind of saying that it's not a deep parameter. Beta is not, in some sense, a deep parameter, because we're going to say that regulatory agencies may, in fact, try to focus on better corporate governance, and that's going to show up in the model as trying to move beta closer to delta.
Great, thank you.
Thank you very much, Eliezer. I just want to continue this question because it's very interesting to me too. So it seems that I read in the previous slide that there is a kind of asymmetric information. So then my question related to the one from Eliezer is that, so it is not myopia, it is not a model of irrationality, it is a rational model. The question is, do you want to model a kind of present bias? Then the model is not rational, or do you want to model a kind of asymmetric information? Then the model is rational, but with different sources of information that could lead to different behaviors.
Yeah, and I these are excellent questions. Both questions are excellent, and I mean, I think in this paper we're just trying to be just like Michael's question. There's a lot of reduced form parts to this, and we're not taking a stand about rationality or not. It's just, I'm just going to kind of think of, I'm going to parameterize a governance problem as having a beta that's different than a delta. I'm going to show you in the next slide. I think it's going to become much more clear why that basically you get a wedge. Again, this is kind of a reduced form thing, but I'm a macroeconomist. And macroeconomists work with wedges all the time, and you'll see that wedge in a second. So let me show you that on the next page. Then, so given all this, so what do shareholders do? Well, they figure out what the the profitability of banks are going to be. So this is, but they're using the their discount factor to so there is this difference in discount factors between what the manager and the shareholder is using to discount future profitability. So in this is the just an expression for the present discounted value of future profits for the bank. And free entry is going to say that if the present discounted value of future profits for a bank exceeds the costs of entering, the banks are going to enter. So the free entry condition, given what managers are going to be doing with respect to their choices of S and D, which show up here and here, we're going to pin down the number of banks through this free entry condition. So let me show you, before I take other questions, let me kind of show you this, because I think this gets a little bit at some of the questions that are coming up. So I can take, all I'm going to do is think about solving this problem 2 and 3, okay? So solving this problem 2 and 3 is going to lead to, there are going to be 2 first order conditions in S and D. So, and then here I'm just going to assume, so this model that I'm writing down, again, to keep things simple, it's going to be a symmetric equilibrium. So all banks are going to be the same size. I don't think all banks are the same size. That's what the paper in Econometrica was kind of thinking about as well. But here is a simple version of what happens in a symmetric equilibrium. So that first order condition with respect to S, after some rearranging, it says that the probability of success of the bank's loan portfolio, so think of that as what is on the left-hand side, the probability of success of the bank's loan portfolio, it's going to be positively related, because remember, P prime is negative. So it's going to be positively related to the interest margin, which is kind of a measure of profitability of the bank. So more profitable banks, so if R is higher, the higher banks are going to, try and guard that profitability in some sense by taking less risk, because they are getting these high returns anyway. They're not chasing because they have low profitability. But then there's this other term which is kind of important. So notice that this is the inverse of leverage. So a more highly levered bank, which means a lower number of this, is going to generate a riskier loan portfolio. So, I think if I had asked you beforehand, do you think highly levered banks are going to lead to more instability or less, more fragility, you would have said yes. That's coming in this term. And then there's this term W, which is what I'm calling the agency wedge. So, here's that, this is the definition of what omega is, or W is. And notice that if shareholder and bank manager, time preferences are aligned, if their preferences are aligned, then delta is going to be equal to beta, and this wedge is just 1. If delta is higher than beta, this W is going to be less than 1. So if there's an agency conflict, so this is a number that's less than 1, it's going to generate more, lower or more risk. Think of it as more risk taking. So that's the sense in which the agency wedge can actually generate more risk taking. So that's this equation. Just quickly, the interest margin is going to be, that's the definition of the interest margin. It's just given by, this is the marginal cost of taking in funds over the number of banks. So if N is a big number, so there's a lot of competition, there's lots of banks out there, N is big, this here is small, and you get lower interest margins. Okay, more competition, lower interest margins. That's all that is said here. Okay, and then policy. How do I think about policy? I'm worried I'm going to run out of time. Oh boy. Here's the government budget constraint. You know, if there are, in cases where there are failures, deposit insurance kicks in. So this would be the expected outflows associated with deposit insurance. And when, you know, how is that funded? Well, it's funded through, as Michael said, FDIC, you know, kind of tax, but also, you know, this F is what the inflows that have to come in to, or the, you know, in some sense, it's got the deposit insurance has to be funded somewhere. So you can think of this as the tax on households for over and above what's being taxed on banks. And then the policy problem, you know, I'm going to think of this I'm thinking of this like a macro person that, you know, solves a DSGE model. We have, you know, like these models kind of have a policy objective function, and then policy is going to be chosen to you know, minimize any costs. Here it's minimizing deviations of output, expected output from what let's say a policymaker wants or a planner wants, and deviations of risk taking from what the planner wants. And it has a whole set of parameters at its disposal, or policies at its disposal. So what is an equilibrium? So an equilibrium is basically, I'm just going to look for a symmetric steady state Cournot equilibrium. And that's where I said, this is the simplest possible. I've never written a paper with 3 equations and 3 unknowns. So, you know, this is my way of trying to get at some of the issues that we'll see in a second in the simplest possible framework. So it was that first order condition for risk taking and deposit funding, or you know, loan portfolio success and lending, and then the free entry condition. And then you know, what the paper does is it runs these policy experiments. So the policy experiments we're going to think of is that in the short run, you know, policy is going to affect the short run profits of a bank, and then eventually, because of free entry, we're going to get to a new kind of market structure. Here we're taking the transition to the new market structure, you know, kind of parametrically. Here you can think of, for the parameters that we use in the calibration, it's that same upward sloping graph that I showed you, that the transition between one and the other steady states was basically 20 years. So that's how we were kind of thinking about it. Okay, so that's what we need to solve for in an equilibrium. We take this model really simplistically to the data, and what data we're using is this data from Ross Levine has constructed. I think the papers are in RFS, or I don't remember where these papers. He has several papers that are published using kind of these ideas from the data. The market, you know, in the IO, you kind of define a market by, you know, you define a market and then you see how many banks are in the market. I can't recall exactly their definition of how big a market is, but basically, on average, their markets were about 3 banks in a given market. So the model, we choose in some sense kappa to match the data on concentration in a given market. The model doesn't do, you know, it just underpredicts drastically the return on assets, but, you know, this is a model that only has interest earnings, but banks have interest and non-interest earnings. We don't have that in the model, and we don't have many shocks in the model. So the variation in the return on assets in the model is not nearly as high as in the data. You know, the model matches leverage in the data and you know, how big the scale of average banks are in the data. Okay, so now I finished the parameterization. So this is let me take you through this because this gets at like sort of really the essence of the paper. And it's also, you know, what is very similar in many ways. So you guys can all ask Jonathan about these things as well. So I'll show you how we relate to Jonathan's work. So on the horizontal axis are the number of banks. Remember, the benchmark for us was our baseline. We had 3 banks in a market. So we're going to do some going to think about changing things, thinking about how competition affects stability and efficiency relative to that benchmark. So, what the experiment is to kind of say, what if there were 5 banks, so more competition, that's down here. What if there was 1 bank, less competition, that's down here, okay? So, you know, if there's a monopolist, that monopolist, you know, you can think of that monopolist is going to be able to charge a high markup. That's what this is. We call it market efficiency, but that's the markups here, or interest margins. Because they get a high markup, they want to guard that markup. They want to guard their position, so they don't take a lot of risks. They want to stay in the industry garnering these high static profits. That means that the, you know, risk taking is low and probabilities of success are high. If there's a lot of competition, then you know, margins are low, and so banks start to take on a lot of risks. They chase, you know, higher returns, but they're the risky returns. And that leads to lower success probabilities. It also, you know, because there's lots of competition, there are very small margins. You know, this is relative to the benchmark, margins fall. A monopolist lender makes a lot of loans, but there's only one of them, so aggregate lending relative to the benchmark is lower. If there's lots of banks, each individual bank is smaller. It's taking on less deposits, but the aggregate of them leads to higher lending in the economy. Because static profits, it's not just static profits, but that's one element in what valuations are. But, you know, a monopolist has a higher, you know, in some sense, stock market value of the bank. As there's more and more competition, each individual bank's valuation drops. And because, you know, monopolists are in some sense trying to guard their charter value, they're taking less risk. The variation in their returns is lower than the variation of returns in a more competitive environment. And so, you know, what you get here is if you were to solve the planner's problem or the policymaker's problem that we had. So these 2 dots correspond to the planner solution. And what this is saying is that the planner in this economy would have chosen less risk-taking than the decentralized economy. And then what we did was we chose kappa to minimize that policymaker's objective function, and that minimum led to entry barriers that were, you know, like kind of implemented effectively a duopoly. So, you know, this sense in which I'm saying that this is, you know, Jonathan has some work, it was kind of getting at these trade-offs, right? That more competition lowers interest margins, which means more efficiency, but at the same time, it lowers the success rate. Okay. Okay, so now I have to judiciously think about. I have 10 minutes. So what I want to do, I'm not going to. I don't think I'm going to go through these perfectly, but I'll tell you the experiments that are going on here. So what we did was we fixed the short run, the market concentration, you know, to you know, n is equal to 3, And we said, what if there's an unanticipated change in that they tighten the leverage constraint? Well, you know, you're used to hearing, I mean, I don't know, I was always used to hearing bankers say, well, if you start, you know, putting on capital requirements, we're going to be charging higher interest margins. It's going to result in higher loan rates. And, you know, that's what you see going on here. But because the blue line is risk taking and that's less than zero, you get leverage, you know, tightening leverage actually leads to less risk taking and less loans in the economy. The implications of that is that you know, because of the higher margins and the you know, less risk taking, it actually can lead to higher long run valuations of banks, and that you see that kind of coming here. And if the long run valuation of banks goes up, you might get more entry in the long, and that's you see more banks arising here. We also do monetary policy counterfactuals, you know, and show just intuitively if the Fed raises, you know, borrowing costs in some sense through Fed funds, contractionary Fed funds policies, because that lowers bank profitability, it's going to have an impact on risk taking, et cetera. And I'm going to show you that that is what we find in the data. Okay, so you know, even though this is a really, really simple model, I think there's ways to interpret the model. And so on my website, I actually have like the MATLAB code to run this model. And so if you want to think about what's the impact of, let's say, a rising shadow banking industry, well, they're going to compete, shadow banks are going to compete with commercial banks for raising external funding. So, you know, if you want to think about that, that's just like a change in this parameter gamma. You know, you can run regulatory arbitrage. I think of that as being if capital requirements are raised or leverage constraints are made tighter, it actually leads banks, leads funds to going over into the shadow banks, and so that would be a change in gamma. You can think about fintech as a change in this parameter eta. You can think about business cycles. The model generates, you know, pro-cyclical lending and things like that. There are two interesting other, you know, like we did it for a model where there was not too big to fail, but you can easily put in too big to fail. And then given that what just happened with SVB and spillovers, you can actually, one way to think about spillovers in this kind of context is to expand that, you know, my choice of riskiness also depends upon what other banks are doing, and you can get these kind of contagion externalities that arise. I'll don't have enough time to go into that. So I know I'm running out of time, so I just want to, here's where I want to kind of go very briefly to the data work, because it's kind of cool, and it's our way of kind of saying, does this model make some sense? So I've got to try and do this in the next 4 minutes, I think. So what Ross did was build this really cool data set, and the coolness of it is that he kind of uses a gravity model to kind of think about when a bank from one state where its headquarters were, when it enters another state, you know, if you think that it knows less about the information of the other state, farther away, it may be, you know, less and less information about the other state, et cetera. It's hard to move managers, et cetera, farther. So he uses that to generate not only state and time variation, but actually bank-specific variation which means a lot bigger data set, more variability to try to identify some of these some of the effects that we're talking about. So what I'll show you next are regressions of the standard deviation of stock returns. That's going to be the dependent variable on fixed the time and bank specific fixed effects and things. Certain like things that are important, like leverage of a bank, but also measures of competition and contestability that he's constructed. Here's in the interest of time, here are the results. So you see that bank competition. So this measure of bank risk, right, the volatility of stock returns, run on the measure of competition. So what this is saying, the positive coefficient and strongly positive coefficient, is basically saying, more competition, more volatility of returns, and that's the measure in some sense of bank risk that we're thinking of. A more highly levered bank leads to higher risk. That's not that surprising. Here's the impact, of so the measure of better corporate governance. He's got ones that are on institutional ownership and blockholders top 10. So if there's big companies overseeing the governance of these banks, or big investors, I should say, overseeing the governance of banks, they're going to try to be more diligent, and they find that we find that lowers bank risk. And then remember, I said that there was an interaction term, and that also comes in. It's a flip because remember that interaction term was in first. It's a flip from what I had before, and that comes in highly significant. So the last thing I'm going to show you is that monetary policy itself may, in fact, affect bank risk taking. So here's again, we've got this measure of bank risk, which is the volatility of stock returns, but also here you see that a measure of an increase in a bank specific measure of exposure to the Fed funds rate leads to more risk being taken. And there are different measures of how we get these bank-specific measures of changes in the exposure to the Fed funds rate. And then, the model makes predictions about interaction effects there as well. And the model is corroborating the predictions. The data is corroborating the predictions of the model along that dimension. So I'm going to end on that. And just say that I think that hopefully this is a really tractable, simple analytical framework to understand the interaction between competition, stability, and efficiency. I'm hoping that and love to speak more, not only today, after this, but you can just email me back when I'm back in Madison and stuff, and I'm happy to keep talking about this stuff with people. But it can be used for regulatory and monetary policy analysis, and it makes predictions for a lot of things. A simple model makes predictions about concentration, bank entry and exit. Leverage is endogenous in the paper. Interest margins are endogenous. The value of banks is endogenous, and it also makes predictions about how much the FDIC is going to have to dole out to fix things. And as I said earlier, there's this some code on my website that you can just run some of these things yourself. For instance, it could be a very different market structure in different countries, and you just change what we did in one of the parameters of the model. So I'll leave it at that. Thanks. This is fun to talk to you guys. So I'll stop there.
Thank you very much, Dean, for this very interesting presentation. So we will take questions on the paper. So just to be clear, we have two kind of discussions. We have 15 minutes discussions on the paper and the presentation, and then we will have 15 other additional minutes to discuss and ask you questions related to the news maybe, and what is happening in the world of financial stability. So please raise your hand if you have any questions. So I will ask my question in order to wait people asking there. So in one of the first slides, you enumerated some condition assumptions of your work, and then of course the first one is today critical. So it's related to the situation today, but it's related to your paper. How would you? And I saw that you also analyzed a lot of cases of the too big to fail and the other cases, how to model the alternative cases or additional features. And so my question is more related to the first condition. How would you model a share of uninsured deposits? How would you model a bank, or thinking of a set of banks that have uninsured deposits, and how would you put that in a very tractable and nice model?
Yeah, that's a great question. You know, that's I don't have it here, but you know, our bank balance. But Jonathan's question is really kind of about our bank balance sheet. What is literally our bank balance sheet in this paper? So our bank balance sheet would be that you have deposits. So what are the liabilities? It's deposits, and it's also equity. I would put equity down here, and then the assets are loans, and then you know this kappa. You can think of kappa as the physical plant of all the branches of a bank on the balance sheet of that we're using for the from the call report data. You actually have that kind of what the real assets of the bank are, which are its bank branches, etc. So you know our balance sheet would be D and E on the liability side, and L and kappa on the asset side. Now, you know, the good question that Jonathan was asking is that, you know, in the real world, if you were to look at the bank balance sheet, it's going to have not only D and E, and where the D is insured deposits, but it's also uninsured deposits, wholesale funding. And, you know, if you start to take a corporate finance kind of a viewpoint on things, and this is borne out in the data, you know, bigger banks tend to have more wholesale funding, borrowing through wholesale funding and stuff like that than smaller banks. Smaller banks, because, you know, if you kind of think of smaller banks as there's an information problem, whatever it is, that makes issuing equity or makes you know, borrowing more expensive, it's consistent with that kind of a, you know, lack of Modigliani Miller kind of world. So I think that I've worked, let me put it this way, I've worked a lot on models of firm bankruptcy. You know, Pablo and I have a paper in RE Stud on exactly the question you're asking about, you know, external funding for non-financial firms. You know, you have to price it. It's how does policy affect those prices? You know, but it was not a simple thing to do, but I do know that there are some papers that are out there that are trying to get at the implications for wholesale funding of different policies and kind of different events. So, you know, one of our students at University of Wisconsin, April Neal, is kind of looking at what the implications of bank resolution policies are for wholesale funding of banks of different sizes, et cetera. But yeah, that I wanted to keep this 3 equations and 3 unknowns. The way I would, the way I would kind of do that, I'd have to put in a zero. I think of the, there's external lenders. I'd have to kind of have another interest rate out there, which is the return on, uninsured deposits or uninsured borrowing, and have a zero profit condition that lenders are going to, kind of the interest rate is going to have to be consistent with the profitability that probability that a bank is going to go bankrupt. So, I don't think it's impossible. Maybe I'm glad you asked it. I mean, maybe I could do something like that. That might be, maybe I could do that to keep things simple. I could do that in the section that I called here, robustness. I could maybe introduce uninsured borrowing. That would be interesting. I'll think about it.
Thank you for your reply. If you have any question, please raise your hand. I see that there are no handed raised, so I will ask my second question. So I was very interested by the conclusion, and it's a pity you did not have too much time to deepen your conclusion, and especially the policy implications of such a war. Because you say in the conclusion slide, I don't remember, but it is useful for policymakers and provide some analysis for the policymakers. So today, that we are in a quite turbulent time in terms of financial stability, especially in the US. How would you use your model? I'm a central banker. I would be interested to use your model to get which kind of insights.
I kind of think that I'm going to try and answer that a little bit here. I don't know that this is a great way to answer it, but I'm going to think about one way to think about what's going on today. I mean, that SVB goes down, and then so you have to understand. One thing is, I'm sorry, but I'm in Portugal teaching this class, and I haven't had much time to even read about what's going on out in the real world. I've just been spending almost all my time teaching. So, but I do know that there was another bank on the East Coast, I think, that went down. I don't know, something's happening on another bank on the East Coast. So I kind of think about that as, is there some form of contagion in the model? So what other banks are doing, that would be, SVB is here in S-bar. And what my bank is doing, was it Signature Bank? I don't know, something that seems to ring a bell. What I do, depends upon what others are doing. So, higher risk, in some sense, higher risk taking by other banks is also going to affect my probability of success. So, one way to kind of think about what we were doing, before was a model, set the parameter psi equal to 0, and now I'm going to start to make the psi be positive, and so here, that generates a strategic complementarity. So here's where you can kind of see that if other people are taking more risk, then it makes me want to take more risk. If if there's a bigger externality, it also generates, more and more risks. So the more interconnected, I know that, Michael works on models with network externalities. The way that this kind of a simple framework would be is to kind of think about what are the implications of changing, this parameter psi for the model. If there is, a bigger psi is going to be generating more risk taking. It generates more lending, but it also, it leads to a less stable economy. So yeah, so what can you do? Well, I mean, that's where if you start to believe that it's going to generate more risk taking and more lending, then you have to start to impose different policies. You might change leverage constraints. We saw that leverage constraints are going to impact, cut down on risk taking and stuff. But that all comes at the expense of having less lending, a smaller economy. So that's the kind of trade-offs that you would have in this kind of a class of a model. So I don't know that answered it as well as you would have liked, but I kind of think this is the whole reason we put in this portion of to the paper, was to kind of get at some of the issues associated with spillovers that other, but we were doing it in a totally ad hoc. I mean, there's a lot of, I'm the type of person, I do like to work on deeper models than this. So this is probably the least deep model I've ever kind of written down, but it does, it does, you can start to kind of change. You could take the program, start to change the, the psi, the spillovers, and see what the implications are for observables that were in here, right? I mean, once I change one parameter, all these endogenous things are going to change in the model.
So this is exactly related to the following the follow-up question, and after we will switch to more actual based questions. In your model, you don't have any.
I truly fear that you're going to be very disappointed when you start asking me policy questions.
No, don't worry.
Really
I'm sure you have a lot of answers to provide us. So just related to your paper, so why I ask this question is, compared to my paper, in my paper I have inflation, interest rates, the central bank that is moving its interest rate according to inflation and output. And here in your paper, there is almost no monetary side, and there is only financial stability, which is okay, which is a focus of the paper, and it's great. But then when we are talking about policy implications, we want to know how to use all our tools simultaneously and how. And I'm not disappointed of your reply concerning the trade-off between stability and competition, but there is still a question about the other tools that we could use to improve the situation.
Okay, so yeah. So let's kind of go back to this monetary policy thing. So how to use the model for monetary policy. So remember that at least in the data, and I want to remind you that this data, the way he constructed this data was to say pre-Regal Neal, which changed a lot of the regulatory, which changed, the ability to branch and all that kind of stuff. What was the impact of, we did Fed policy pre-Regal Neal. you know, things like risk taking, et cetera, in the data and in the model. So at least, you know, for the sample period that we were looking at, we had that monetary policy led to more, you know, more volatility, more risk taking. So so first off, I totally agree. This is a real model. Okay, so this is all about, you can think of the Fed in a model with sticky prices. The Fed has some ability to affect real interest rates, at least in the short run. One of the questions is, in the long run, does it have any impact on interest, you know, like real interest rates? So, you know, in some sense, I think of this little alpha as being, you know, what is the real cost? As I increase alpha, what is the real cost to banks of making loans? And you know, so we have nothing to say here about how it's going to affect inflation, but it, you know, it does. I mean, the one thing I want to kind of get at is that, you know, what you see is there's a decrease in aggregate lending here, right? It's when the impact effect of a rise in the Fed funds rate is a decrease in aggregate lending, that's cooling off an economy in the way that when I come over here, you know, that's going to have an impact on Y, right? Now, you know, we don't have, so when we kind of do our policy experiments, we're also kind of thinking about how it affects, you know, aggregate output in the economy and stuff like that. So here it's making, you know, it's a bad thing, right? That when I raise the Fed funds rates, I'm going to have a lower expected output. That's bad, and we don't have the good part that that's actually trying to combat inflation. So, you know, the model is silent about inflation, but you could always, you know, again, you could always kind of be starting kind of think of, well, as Y decreases, if you had an ad hoc kind of Phillips curve, you could add that to here. I know that's ad hoc again, but it would again get at some of the trade-offs that policymakers have to deal with. So yeah, I mean, I think of this, let me say, you know, I don't think this is a model that's good to speak about in, you know, how monetary policy affects inflation, but I do think it's important that when policymakers are changing, you know, monetary policy, running contractionary monetary policies, for instance, it can in fact affect market structure. And so that's, you know, and that's all kind of running through, you know, the impact of borrowing costs and like, and all that. So there's an exogenous change in borrowing costs, but when you know, the market structure starts to change associated with that policy change, you're going to have an endogenous response in the long run to what you're doing to you know, bank borrowing costs, et cetera, that's on the real side, not so much thinking about you know, like the inflation side. So this was just meant to say, hey, when you do monetary policy, in order to think about inflation, think about what the impact it might have on, you know, all these other variables. And what's really different is, you know, the impact it might have on concentration, on bank entry and exit, and also because it's a model with imperfect competition, what it might do to interest margins.
Interesting. And thank you very much for your reply. So now we will open the discussion to a more broadly situation. So feel free to raise your hand if you have any questions related to financial stability and banking competition, because we have a great expert today. If I don't see any hand raised, or I will ask again another question related to the news. And so if you were, and it's also related to my previous question, so if you were a policymaker, if you were the Fed, so it's a two-part question. First question, would you have done what they have done at the risk to, alter the financial stability? And what would you do to solve the current issue in terms of financial stability? It's not an easy question. I'm sorry. I know you are not you are not yet the governor of the Fed, but
no, this is a hard question. I mean, obviously, let me I want to say one thing again about what the Fed does. I mean, and this is something that Darrell Duffy, I think, has thought a lot about, and I respect him tremendously as a financial theorist. He actually came to Wisconsin and gave a lecture on how bank resolution may affect things. I think that my whole take on this would be, whether they let a bank fail or they keep a bank propped up. I mean, I think they're letting the bank SVB fail. But what happens that way is going to influence bank entry. Obviously it influences exit, but anything that influences exit influences entry, and what influences entry, and exit affects what concentration is. So, I still have this. I think there's a beautiful paper by Hugo Hoppenheim and Richard Rogerson, which was kind of getting at in Europe during Eurosclerosis. There were a lot of calls to say, just put on firing costs, because if you say that firms can't fire people, then there won't be as much unemployment. The thing that misses is that if firms can't fire people, then you might not get firms, entering in the first place, because they're going to be bearing higher costs in the future. So, their paper actually says that actually unemployment can rise if you put on firing costs, and that's kind of the unintended consequences of these things. So, I guess what I think to answer this question is, in a very roundabout way, the implications of whether we have too big to fail, in some sense, should that bank have been up or not? It's a really complicated question, because it changes. I mean, that's where, you'll see in this too big to fail one, we just, if banks, are propped up, they're going to take on more risk. And so, the discipline, the market discipline of saying that they're not going to bail out a bank, it has big implications. Again, if they're going to take on more risk, and the market will be less stable if we were to prop up banks like this. Again, I'm going to say that I think a really good person to ask that question would be Darrell Duffy, because he's thought about how to resolve the best way to resolve banks. I will say one other thing. Again, this is something from one of the students at Wisconsin. She's actually kind of thinking about, there was a change in how banks are being resolved in some sense. There's a movement to doing bail-ins rather than bailouts. And I characterize a bail-in as something like, and I have a paper in RA Stud that's about thinking about a version of bail-ins for non-financial firms. But I think of bail-ins as being, this firm is about to go bankrupt. A bail-in would be just take the firm that has a lot of debt that it can't pay off, wipe out the debt, and give the creditors first an all equity bank. So in the case that you were asking earlier about wholesale funding, would I take those creditors that I owe something, they're served first, and we wipe, we're not going to make any payments to them, but we're going to give them, in some sense, shares in this all, in that case, it wouldn't necessarily be all equity, but a debt-free bank, wholesale debt-free bank. And that has implications for, also for like allocation of resources in an economy. I think is an important question. This woman, April Meal, is actually kind of looking at the implications for the U.S. banking industry of having a bail-in, and because we haven't, until this big bank failure, I mean, they were the 16th largest bank, if I understand correctly, SVB. That's a big bank. We didn't really have any examples of this with thinking about like the new policies that have been instituted in the ECB, and it's on the books now for US of these kind of bail-in policies. So it'll be interesting to see what's going to happen that way. Obviously with the externalities, that's the thing that's tempering this. That's the part that's tempering the benefits from incentives not to take risk. It could spill over. I think the best person to ask this question is probably Michael Goffman, if he's still there.
Come on. I mean, let's just focus on one very simple thing, right? That the reason why the mess has started is because of this increase in the interest rates, right? So in some sense, once you hold this long-term bonds and you increase interest rate, you have losses. Like Fed sits on $1.2 trillion of losses. Right now, SVB also had a couple billion of dollars of losses, but it's not like specific to SVB. Any bank that holds long-term maturity bonds would have this hit, right? And any bank that has uninsured depositors could potentially have a run, specifically because they don't pay like high interest rate on the deposits, right? They all kind of think that the depositors are stupid, right? And then they perceive the funding to be stable. But once the Credit Suisse is in trouble and Signature Bank is closed, SVB is closed, then the word is out in all the news that now there is some instability going on. And then the whole thing seems to be like inherently unstable. So what's your prediction for the future? Yeah, like how is it going to stop?
But so let me just say, from the only thing what I should have said, just to tie this back to the model, it is the case. I mean, what Michael just said was, and I know this is on different wholesale, funding rates and things like that, but this simplistic model can't quite get at that. But what the model does predict is that in a rising interest rate environment, which is what I would call the alpha getting higher, there's going to be more risk taking going on. That's a prediction of the model. So
but there is no more losses, right? You don't have more losses. You don't have the PS is not increasing with alpha, does it? Oh, the 1
yes.
minus PS.
Yeah. So S goes up, right? And the probability of success falls. So, if alpha goes up, right?
Yes. If alpha goes up, S goes down, no?
No, if alpha goes up, then because profitability is decreasing, banks take on more risk.
But actually, like, isn't it the case that when the Fed increases interest rate, and also like all over the world, that loans part, the banks very fast to update the pricing on the loans, like it's 1-to-1. But on the deposits part, they kind of like expect people to be slipping, and they don't really pay you much. I mean, Chase still pays me 0.01%, like despite that the interest rates went through the roof. So wouldn't that mean that they make more profits, right? And then they're also facing more risk because the fragility of their funding increasing. Isn't that the case?
Yeah. So I mean, this is kind of like, I just want to make clear, this is the fact that if you increase monetary policy, you know, you have in the short run, it's going to be that banks take on more risk. Okay. And in the short run, they lower the amount of loans. That, you know, these are the kind, this lowering loans is what the monetary policy would basically go out and say. Now, in this model, what you're saying is that, you know, this, what we predict with this model, we don't get, you see, in this model, what you were saying about deposits being sticky, right? That's not what's happening. We don't have stickiness of deposits and things like that. So, you know, the impact effect here is actually a decrease in interest margins. And whereas in the stuff you were saying with sticky deposits, you know, you might in fact get an increase in margins. Here, this is making an opposite prediction, which, you know, I agree with you. I think that deposits are sticky and loans are much more, much quicker to change. Now, on the other hand, you know, deposits is loans, there is a maturity structure, again, that we don't have here. And so depending upon the number, you know, how many, the maturity of bank loans, you know, there's stickiness that's going on there as well. And you have to, you know, trade off those two things. But the simple thing that you said, Michael, that, you know, in a higher interest rate environment that, you know, the Fed is conducting, we might see more risk taking happening in the short run. You know, that's a prediction of the model. And, you know, so I didn't get to kind of say these things, but, you know, in this part of the paper, you know, to kind of understand how monetary policy affect things, what we did was we kind of said, okay, what's going to be the impact in the short run on some of these endogenous variables, and then you know, given what happens in the short run, what's going to happen to you know, bank entry and exit. So let me just kind of you know, this is kind of more the big picture kind of thing. So if
but then when you say exit, you don't mean bank run. It's like just endogenously, like less entry.
Exactly. Yeah. This doesn't have, you know, the only way I guess I would have to try to think about how, you know, just like so let me say, you know, here, you know, I kind of said what, you know, how can I think about regulatory arbitrage? So one way to kind of think about regulatory arbitrage would be to change a couple of parameters at the same time. And so, you know, like I think of if there's higher leverage requirements, then funds are going to move over to the shadow banking industry, and I'm going to kind of parameterize that movement over by a change in gamma, right? So you can kind of change certain parameters in unison to kind of get at something. I think the one that you're talking about right now is I would have to change, you know, my measure, the Fed funds rate, which is alpha. And at the same time, I might say something about changes potentially in the spillovers here and see what the implications would be. Because they may be moving in different directions. I don't, you know, it would be interesting to do that kind of account.
Thank you very much, Michael, for your question, and Dean, for all your replies. It was fascinating, interesting, very good, and I hope you will find this paper will find a great home in the academic world.
Well, you know, I just as an aside, it takes me about, and Michael knows this already, it takes me many, many years to write papers. So this has, you know, we have made a lot of progress on this paper, but I have a really cool paper with Michael that's even older than this one that I got to finish first. So we'll see. And I
so Dean, do you mean that Michael is here to remind you that we have to work?
Exactly. He's yeah, my incentive device. So, by the way, I just want to say again that, you know, while you know, I don't know how much we could schedule. I've been, you know, now it's probably about 5 hours that I've been talking and stuff, but I really hope that people feel free to contact me about, you know, this paper, their paper, and things that we should be doing differently in this paper, that they would like to see being done in this paper. Yeah, because we haven't submitted this paper yet. I figured I needed to finish the paper with Michael first. So
I think your paper and the one with Michael too are very related to the news, and maybe it's time to go for publication. I don't know.
Yeah,
but yeah, I think you know better than me this word. So again, thank you very much for your presentation. It was a fascinating paper and presentation. Very interesting discussion. People who are attending, feel free to ask questions directly to Dean by email. Dean, thank you very much. I hope to see you soon here.
Great. Thank you. I really appreciate doing this. This is a lot of fun, and yeah, I hope to see you guys maybe in Israel sometime, etc. So
we hope to.
Thank you.
Thank you very much.